1.8%. That is the annual decline in the average UK house price for the 12 months ending December of last year, as reported by Nationwide Building Society. While this figure might suggest a minor market adjustment, a closer examination reveals a more complex narrative, indicating a significant shift in the UK housing market outlook. The current situation presents a contrast between official assessments and the financial realities faced by many. While certain property portals and lenders express cautious optimism, there is an ongoing challenge with affordability alongside historically high interest rates, leading to a re-evaluation of market stability. Analyzing the data provides a clearer picture. In December 2023, the average house price in the UK was £285,000, according to Nationwide. This reflected the 1.8% annual decrease. However, a subsequent report from Rightmove in January 2024 indicated a 0.7% month-on-month increase in average asking prices, reaching £359,748. These figures, while seemingly divergent, represent different aspects of the market. Nationwide's data reflects past transactions, whereas Rightmove's data indicates current seller expectations and buyer interest. The primary factor driving this market reorientation stems from actions taken by the Bank of England. In August 2023, the Bank of England base rate reached 5.25%. This marked a departure from an extended period of low interest rates that had previously fueled property value appreciation. The Bank of England implemented these rate increases as a measure to combat rising inflation. Inflation had indeed reached significant levels, with the UK Consumer Prices Index, or CPI, peaking at 11.1% in October 2022, as documented by the Office for National Statistics. This peak represented a 41-year high. Such inflation directly impacted everyday expenses, from groceries to energy costs. The Bank of England's decision to raise rates was a direct response to this economic pressure. More recently, inflation has shown signs of receding. By December 2023, the annual CPI inflation rate had decreased to 4.0%, according to the ONS. This reduction has influenced market sentiment, prompting discussions about potential interest rate reductions in the future. Robert Gardner, chief economist at Nationwide, commented on this evolving sentiment in January 2024. The housing market ended 2023 on a soft note. However, a rapid fall in inflation and the belief that the Bank of England is likely to cut interest rates in 2024 has led to a more optimistic outlook. This suggests that a decrease in inflation and the anticipation of future rate cuts have begun to positively affect market expectations, leading some lenders to cautiously adjust fixed-rate mortgage offerings. Despite this shift in outlook, the financial strain experienced over the past 18 months remains significant. Homeowners whose fixed-rate mortgage deals expired in late 2023 or early 2024 faced substantially higher renewal rates. These increased costs have had a considerable impact on household budgets. Tim Bannister, Rightmove's Director of Property Science, noted in January 2024 that the housing market has started the year with more confidence and is heading in the right direction, but it is still a price-sensitive market. This indicates that while buyer interest has improved, price sensitivity persists due to elevated borrowing costs. Transaction volumes further illustrate the impact of rising interest rates. HM Revenue and Customs, or HMRC, reported 99,260 residential transactions in December 2023. This represents a 17% decrease compared to December 2022. Such a reduction signifies a slowdown in market activity, affecting various related sectors. The market timeline provides context for these developments. From late 2021 through early 2022, the UK housing market experienced growth. This period was followed by a sharp rise in inflation and subsequent interest rate increases by the Bank of England, beginning in the spring and summer of 2022. Inflation reached its peak in October 2022. Over late 2022 and mid-2023, mortgage rates rose considerably, leading to a reduction in housing market activity and modest price adjustments. August 2023 saw the Bank of England base rate reach 5.25%. The latter part of 2023 showed signs of cooling inflation, influencing expectations for future rate cuts. By January 2024, Rightmove reported an increase in asking prices and buyer demand. The current market shift is driven by the faster-than-expected decline in inflation and the resulting anticipation of future interest rate reductions by the Bank of England. This shift has allowed mortgage lenders to tentatively reduce their fixed-rate offerings, introducing some positive sentiment into the market. However, differing perspectives continue to exist. While some sources highlight improving demand and asking prices in early 2024, many economists remain cautious. Affordability issues persist, as current mortgage rates, even with potential reductions, are higher than those observed in previous years. This continues to pose a challenge, particularly for first-time buyers. Market performance also exhibits regional variations, with trends differing across various parts of the UK. National averages may not fully capture these localized dynamics. The current period signals a transition from an era of consistently rising property values, previously sustained by low-cost credit. The market is now characterized by higher borrowing costs, increased buyer scrutiny, and heightened sensitivity to economic indicators such as inflation and interest rates. The unexpected pace of disinflation has introduced a degree of optimism, shifting the overall market outlook from largely pessimistic to cautiously hopeful. However, fundamental challenges remain, including ongoing affordability concerns, the continuing impact of the cost of living, and the sustained effect of higher interest rates on homeowners. The market appears to be in a phase of tentative stabilization rather than a rapid expansion. While a widespread market crash has not materialized as some anticipated, the sector has certainly faced significant pressures. The observed flip represents a nuanced change in market momentum, influenced by macroeconomic factors, moving away from a downturn toward a more balanced, though still demanding environment. The critical question now centers on the sustainability of this optimism amidst prevailing affordability and economic uncertainties.